Since beginning of this week, we could see that the Fed committee members have been talking about the cutting back of the QE measures, and the next week we could see the Fed minutes coming out next week. So, do you expect that the QE would be cut soon?
Well, I think that's the question everybody's trying to guess the answer to, trying to find out the answer to, because everything seems to be driven by that at the moment. In the last meeting, everybody's expecting that there was going to be some talk about tapering. They voted to keep the same level of QE in place, but nobody knows how much longer that's going to last. And until last week, we were getting some fairly strong data coming through, driven entirely by the amount of QE that was going into the system. And yet, in the last few days, the data has started to look a lot weaker. Many of the data points have been much, much weaker.
Do you mean the initial jobless claims?
Initial jobless claims was one. There was a consumer sentiment survey. A lot of the purchasing survey. A lot of these things were starting to look a little bit weaker, and so people were home starts as well. I think was another one. And so people were starting to actually maybe form a view that the economy was not as healthy, and yet the markets like that. The markets saw that meant that the Fed would have to keep this QE coming, and so the markets actually seem to like bad news right now more than they like good news. When they get bad news, we see another new high because they believe that the Fed are going to support with even more QE, and they're going to keep the program going. They're not going to taper. I think the thing that would really spook the markets is if the Fed minutes contain a lot of very, very strong messages about cutting back or tapering the amount of QE or ending it earlier than planned. And if we see that, then
which is possible.
I don't think so. I think the biggest worry is that people start to panic about the language in there. I think if we look at the data that's come through in the last week, if the Fed could rewrite the minutes right now, they'd probably make them a lot softer than they were. But I think the fact that the data is starting to look so weak, I don't think there's immediate risk of cutting back of QE. I think we're going to expect to see that going for some time soon. But if the minutes say something slightly different to that, then you may well see the markets get a little bit spooked. So it's a little bit of a nervous time right now because it's not really relying on fundamentals. We had these positive numbers that were driven by QE, and the minute anybody takes that away, then that's when we really find out what the situation is. Warren Buffett always has a saying that you never find out what the real situation is. You don't know who's gone swimming naked until the tide goes out, and then suddenly you can't hide anything anymore. And I think that's really the situation that people are worried about. That when we take the QE away, we find out how bad things really are, and I don't think anybody's ready to do that right now. So I think I don't expect that there's going to be any immediate impact on QE, but I think if the market is worried about the language that comes out of the Fed minutes, then maybe we might be in for a few crazy days in the markets. That's definitely possible.
But when we talk about the reality about the employment rate or something, right? It has been reducing. Since last year or something.
It's been reducing very slowly, but I mean, there are two factors.
But too slow.
Too slowly. One is the speed is much too slow. We're not creating nearly enough jobs. And the second factor is, you have to look at the basis, the statistical basis that they use here for unemployment numbers. There are people who measure what they call the shadow statistics. They look at the real unemployment. So if you've been unemployed for more than a year, if you've given up looking for work, if you add those numbers back in there, then it actually increases the unemployment rate to almost double. It makes it around 15%, and that really is scary. And that that's really sticking. It's not coming down anywhere near faster. If you look at previous recessions, every time we've had the kind of correction, the kind of recession that we had in 2008, the job market recovers much more quickly. This time we've had more stimulus. This is like unprecedented. We've never had so much stimulus at any point in history, and yet unemployment is still pretty stubborn. It's still 7% on official stats or 15% on unofficial stats. So that's a real worry. Oh yeah, wow. Yeah, exactly. It's a real worry, and these are people in America who are taken out of the job market. So they're not earning income, they're not spending. That's one reason why a lot of the economic metrics are actually starting to disappoint. Even if we look at the housing numbers for the last year or so, you think about the fact that, $45 billion every month has been plowed into the housing market by the purchase of the mortgage-backed securities. That's really not had anything like the impact that it should do. We've seen relatively small increases in residential activity in the States. So.
The economic situation in America now, it's not healthy enough to pulling back the QE, but it's getting better.
It looks like it's getting better, yeah. But I mean, if you invest 45 billion every month into mortgage-backed securities, if you put 40 billion into buying treasuries, then that's going to have an impact. Historically, when we see stimulus, people will stimulate an economy by injecting funds into the economy and expecting to get a leveraged return on that. So, for every dollar that you put in, maybe you expect to get something like $2 or $1.50 of economic activity.
Right.
At the moment, on the research that we've done, we believe they're getting much less return than they're actually putting in there. They're getting less than $1 of economic increase for every dollar that they're investing. So it's very inefficient, and it's almost like a loss. It's almost like a waste of money because they're not actually getting even the same return as they're injecting into the economy. What's coming out is less than what's going in.
Right. So could you please analyze the possible outcome of stop using the QE? For example, like it can be reduced step by step. Of using the QE, and maybe stop immediately, and what's going to happen to the market?
I can't see any way in the current environment that they can stop immediately. I think pressure is building up because people are worried about the amount of debt, the increase in the amount of debt. So I think pressure is building up to cut back on QE, and that's why they use this phrase tapering. It just means getting narrower and narrower and smaller and smaller.
I see.
And so I think what we're likely to see is at some point, and I don't think this is now, I don't think we're at that stage yet, but at some point we're likely to see a gradual cutback on QE. In a sense, that's actually what happened before. We had that in 2008. We had QE1. It ran for a period of time. It stopped. That's why they had to introduce QE2. That ran for a period of while. It stopped. We had QE3. Now we've got the latest. Exactly. Right. So I think, I don't think that things are any better today than they were last year, 2 years ago, 3 years ago. Every time they tried to take the QE away from the market at that stage, then economic activity really started to decline very quickly indeed. Unemployment numbers picked up again. The capital markets suffered from having all that liquidity taken away from them. I don't think we're in any better situation. So I think any temporary reduction in QE is going to have a big impact. And you have to remember that it's not just American QE that we're looking at right now. Some people seem to be a little bit confused or mystified about why markets have been so strong for the last few months when maybe economic fundamentals don't look so great. And I think the two reasons are everybody knows we have $85 billion forced into the American economy every month, but also you have to look at the fact that we've seen all the Japanese stimulus as well over the last few months.
That's a huge one.
It's a huge one, absolutely. So we've seen these two things come together. That's driven up asset prices. It has increased economic activity, but as I say, not in an efficient way, not in a leveraged way, not in a way that makes a profit. It's actually increased economic activity by less than the amount of input that's gone in there. So it's supporting asset prices, but the minute you take that away, the minute you reduce it, I think we're exactly the same place we were when they took away QE1, when QE2 finished. I think we're in exactly that same situation again. So any sign that either America or Japan is going to ease back on the stimulatory policies, the markets are going to take that very badly.
Right. Is it possible to be just like a money game between countries, and they just want to gradually tell the market and investors that in the next few years or in the next few months they will gradually reduce the QE, and they don't want just you chalk the market and chalk the investors?
I think this is what Fed policy has been about for the last period of time. The idea that they brought in this rule where if inflation fell below a certain level, if unemployment fell below a certain level, and if inflation started to increase, they'd take away the QE at that stage. I think they were trying to signal to the markets that there would come a point when everything was under control and QE would be withdrawn. And they were saying, maybe that was a year ahead or 2 years ahead. If you remember about the zero interest rate policy, that was introduced for a year, then 2 years, and it keeps being extended and extended. So I think they're trying to flag very much the idea that they want to increase interest rates at some point. They want to come back on cut back on QE at some point. But I don't think that they dare suggest that that's going to be any time in the immediate future, because the minute they suggest that, consumers get spooked and stop spending, companies get spooked and stop hiring, and the capital markets get terrified, and we see some very, very big corrections in capital markets. And if you look at where stock markets are right now, particularly in the countries that have stimulated the most. So, America's stock market, Japan's stock market, even here in Thailand where we've had stimulatory policies. If you look at the countries that have input the most stimulus into their economies, the capital markets in those countries are very, very vulnerable. Take that stimulus away, then we could see some very big falls. Exactly.
To the fundamental.
Exactly, yeah. When we take the stimulus away, when we take the liquidity away, we're left looking at the fundamentals, and that's scary.
On the other hand, the BOJ would have the meeting in the middle of the week, next week.
That's right.
So did you expect to see any more stimulus package from the BOJ?
I think
that's enough.
Well, they're in a very difficult situation because the GDP numbers actually came through stronger than anybody had expected. The yen probably is weaker now than people had realized that it would be at this point. I mean, everybody was talking about yen breaking 100, but it's happened. The stock market's gone higher. Inflation actually, for the first time ever in Japan is starting to show its face. So I think BOJ is actually in a much more difficult, much more sensitive situation than the Fed. For the Fed, I think when we read the minutes, whatever the minutes say, the Fed have to keep going with this policy. The BOJ, they're really caught in between, trying to maybe be a little bit more responsible than they've been over the last few months, but worrying about trying to undo, some of the positive effects that they've already had. So that one, I think, I'm not sure what we can expect from the BOJ, but I don't expect them to pull back totally from what they've been doing. But maybe we might get some language out of the BOJ that's perhaps a little bit more dovish than last time. So maybe they might keep the policies going, but they might start to flag ahead that the next meeting or the one after that, we might see some pullback in this stimulus, because it almost seems like it's working too well.
When we talk about the impact to the like commodities, for example, like gold, we could see that the money supply from all over the world, from the central banks, that have been injecting to the financial system, but they are not flowing to gold.
That's right.
They just flow to the capital markets all around the world. So what's happening now?
Well, I think there's a couple of things that are happening here. I think one is that in the past we've seen a lot of outflows from US dollar, whereas this time a lot of the money creation has tended to stick in USD, and I think part of that is because it's been split between treasuries and between mortgage-backed securities. So ultimately that's actually created net demand for the dollar rather than net disinvestment, which is what we saw in the first 2 or 3 QE phases. So dollar being strong usually means that that's a negative for gold, because obviously we price gold in dollars. So I think some of the phenomenon of gold weakness is more to do with dollar strength than with people having a problem with gold or turning their back on gold. Having said that, clearly there is a problem with gold because it fell from such a high level, and I think what we're seeing there is gold really had become a risk asset. We'd said this many times before on this program that you put that amount of liquidity into gold, it goes up that quickly, that strongly. Gold isn't a safe haven anymore. It now starts to look like a risk asset. And when people were looking around the risk assets, then equities were starting to look like a better value risk asset. They had more upside. Certainly if we look at markets like Thailand or the States or even Japan, there was a lot more upside to equities. So if people were going to take risk, I think they just transferred the risk from gold to equities instead. So I think we've had those two things going on instead: rotation out of gold into equities and strength of dollar, weakness of gold, both at the same time.